the Tax Cuts and Jobs Act, or TCJA, introduced significant changes to the tax landscape starting January 1, 2018, with provisions affecting returns filed in 2023. Key changes include new tax brackets, increased standard deductions, and adjusted credit amounts. The corporate tax rate was slashed from 35% to 21%, and the child tax credit doubled to $2,000 per child, with up to $1,600 refundable. However, the federal personal exemption was eliminated, and the alternative minimum tax exemption amounts were adjusted for inflation. These changes are set to expire at the end of 2025. In response to the TCJA, Maryland enacted several legislative changes. Governor Hogan signed bills increasing the state's standard deduction to $2,550 for single filers and $5,150 for joint filers in 2023. The Earned Income Tax Credit was expanded to include individuals without a qualifying child, aged 18 to 24. Additionally, Maryland clarified that its personal exemptions remain unaffected by the federal changes. This ensures that Maryland taxpayers can still claim personal exemptions, avoiding confusion due to the TCJA's elimination of federal exemptions. For 2023, taxpayers can benefit from a new subtraction modification for union dues, provided they meet specific criteria. Additionally, there are updates to subtraction modifications, including adoption expenses, military retirement income, and expenses for state-licensed cannabis businesses. The mileage rate for charitable use of a car has increased to 65.5 cents per mile. A new addition modification applies to members of pass-through entities taxed at the entity level in another state. These changes reflect ongoing efforts to adapt tax policies to evolving economic and social landscapes. Filing a tax return depends on factors like gross income, filing status, and age. U.S. citizens and resident aliens must file if their income exceeds the standard deduction. For 2023, the minimum income requirements vary by status: $13,850 for single filers, $27,700 for married couples filing jointly, and $20,800 for heads of household. Filing status options include single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Each status has specific criteria and implications for tax rates and deductions, influencing the taxpayer's overall tax liability. The TCJA retained 7 tax brackets, but reduced rates for individual taxpayers. For 2023, rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The highest rate applies to joint filers with income over $693,750 and single filers over $578,125. Long-term capital gains and qualified dividends are taxed at 0%, 15%, or 20%, depending on the taxpayer's bracket. Additionally, a 3.8% federal net investment income tax applies to individuals with modified adjusted gross income exceeding $200,000 for singles or $250,000 for joint filers. Non-resident and dual-status aliens have unique filing requirements. A non-resident alien is taxed only on U.S. source income, while a dual-status alien is taxed on worldwide income during the resident portion of the year. Non-resident aliens may file jointly if married to a U.S. citizen or resident. Community property laws affect married taxpayers in certain states, impacting income and deductions. Relief from community property liability is available under specific conditions. Additionally, abandoned spouse rules allow certain married taxpayers to file as head of household, providing potential tax benefits.